Welcome to Striking Options, the show that reveals the options you have to better navigate markets. I'm Jeff Kilberg, and I'm joined today by Bob Icino. Welcome, Bob.
Happy to be here, Jeff.
Well, it's interesting. We are in the heart of earnings season, and so far, so good. But we're looking at companies this week like Microsoft, Amazon, Intel, a lot of technology representation. But what else has your attention this week, Bob?
Well, it's pretty much a mix, right? I mean, a mix leaning toward the positive side, but something else I'd like to pay a little bit of attention to is we've got a Fed meeting coming up right in the midst of earnings season, so we'll see how that affects the market.
I heard about that. And that CME FedWatch tool probability is above 90%, correct?
It is, and we're losing a little bit of the steam in the further out months on that FedWatch tool, though.
All right, great point. We'll be watching the Fed, no doubt about that. Let's get into this first lightning round. You ready?
I am ready.
Crude oil. Well, we have seen crude oil rebound. Right back above, is it kind of range bound here, or does it have the opportunity to break to the upside?
It has an opportunity to briefly break to the upside, but I don't think it's going to be very aggressive. We're at the top of the range again, and nothing really has changed fundamentally. So the example I'd like to look at, if you'll let me, is I'm selling the Nove Week 1 58.60 call spread in crude oil. The selling of this call spread allows an investor to collect about $280 when we priced it. This call spread expires Friday, November 1st.
Well, it's interesting. We've seen a dislocation between the equity markets and the crude oil price. So here in the futures contract, we are moving back to the upper end of the range. So you're really embracing this range that's being presented, correct?
Absolutely. It's more of a supply story, and really demand is the bigger story, and that hasn't changed.
No, it's great stuff. And remember, this is the December futures. That's the underlying future contract here. And it was trading around 56.31. That at the money volatility. We talk a lot about the at the money volatility. 32, somewhat elevated.
Yeah, elevated, not outrageous, but still elevated versus historical norms.
Great stuff. I really like it. And please remember, these are trade examples, not trade recommendations. Let's move into the second lightning round, pal.
Let's do it.
FANG. Well, we talked about technology earlier, and here we are. We're really focused on technology. It continues to be the leading sector for the S&P 500, but I'm a little bit cautious going into these new all-time highs. We're about 1 or 2% away. So what's your thought structure going into this earnings season?
Yeah, I like the way you said that, because we're looking at Microsoft that had a good number, but their cloud-based number continued to shrink in terms of revenue. So I think caution is the right thing.
Well, I think in risk mitigation, that's what we are all about here on Striking Options. So I look at the E-mini NASDAQ 100, the FANG stocks that we all love and learn and talk about every day. But I want to be a seller of a November Week 1 8150, 8400 call spread in the E-mini NASDAQ 100. And this expires next Friday, but in the event we do take out that new all-time high, establish it, and come back, it would give us about 7 days in this trade example to watch the earnings season really play out.
Yeah, I love this example. That 8,400 level seems like it's going to be pretty good resistance, at least based on my analysis. So I like the upper end of this particular spread.
Well, in the D's futures, remember the underline here, we're trading around 79.69 when we priced out this trade example. And at the money vol, 15.5, Bob. Not too elevated, but still handsome enough to collect a little premium.
No, again, similar to crude oil, where it's elevated, but not historically too elevated. So it's a pretty good risk mitigator.
Yeah, and the trade example allows an investor to potentially collect about $180, and this is only going out 7 days. So it's remember to understand, we switch up the expiration on a lot of the trade examples here on Striking Options. This is only 7 days, where our typical trade example is about 2 weeks, Bob.
Yeah, and there's something else we could look at based off of what we're talking about happening to the NASDAQ. You could look at the micro E-mini NASDAQ as well.
For sure, and if you're looking for a little bit of a pop from the earnings season, you could have a good till cancel order, GTC. You could be selling one of these micro E-mini NASDAQ 100s at that level, right around 8,400, to kind of mitigate risk if you do have long exposure on your portfolio.
Yeah, and again, at 1/10 the size, it's a very affordable little insurance policy, again, to look at these micros.
Well, Bob, thanks as always for coming on to Striking Options, and make sure you tune in every week as we will continue to strike options.